Now we will begin unit 14, which is real estate related computations and closing of transactions. So for computations, the basic things you need to remember right off the bat are simple mathematic facts. So you have to know the parts of a fraction, the numerator and denominator, changing fractions to decimals, which would be like an example, 1/2 would be 1 divided by 2, and it's 0.5 decimal. Changing decimals to percentages. Example would be 0.5 equals 0.50, which equals 50%. You would move the decimal 2 spots to the right. Changing percentages to decimals. Example would be 50%, 0.5. You would move the decimal 2 spots to the left. And the decimal place values. Okay. So the first thing you do is the first calculation would be a sales commission. So commissions are often shared by the listing broker and the listing sales associate and the selling broker and the selling sales associate. Okay. So the way it works, the formula, you remember the brokers represent, the agents are representing the brokers. So the brokerages get paid and then their splits go to the agents. So you take the sales price times the commission rate and that equals the total commission. So if you have a sale price of $100,000 and a commission rate of 6%, the total commission would be $6,000. So the total commission times the percent that goes to the listing brokerage, and then you have the total commission of the percent that goes to the selling brokerage. So if they split it 3-3, you would have $6,000 times 3%. I'm sorry, sales price times commission rate is a total commission. So 100,000 times 6% is 6,000. So the commission total is 6,000. Now you take the total commission and let's say the brokers are splitting it 50-50. So the total commission times 50% to the listing brokerage would be $3,000 to the listing brokerage. Okay. Now let's say the listing brokerage and the sales agent are splitting that 50%. So the $3,000 that went to the listing brokerage now gets split by 50%. So 1,500 goes to the listing brokerage, 1,500 goes to the sales associate. Do you see how that breaks down? Same thing. Total commission to the selling brokerage, that'd be for the buyer. They would have got 3,000. That gets split 50-50, say, and then that'd be 1,500, 1,500. That's a calculation for sales commission. You can see that on the test. They may ask you, they may tell you the sale price, the list price was this, the sale price was this. What was the commission? The commission goes off the sale price, not the list price, right? It doesn't matter what the list price was. It's what the sale price was, right?
That's right.
So that's how they kind of get tricky on that one. So calculating problems that include percent. Okay, so there's 3 elements common to all percent calculations. You have the part of the total amount, the rate, which is the percent, and then the total will be the total amount of the calculation. Okay. So for example, there's 3 formulas to assist with solving percent problems. There's the part of whatever divided by the total, and that will equal the rate. You have the part divided by the rate, and that'll equal the total. And the total times the rate equals the part. So depending on what you're trying to find, if you're trying to find a rate, you take the part divided by the total. If you're trying to find the total, it's the part divided by the rate. If you're trying to find the part, it's the total times the rate. It's just the reverse of the mathematics. So let's look at an example. How much you make over and above your cost. The formula for profit. Okay, the profit is how much you make over and above your cost. Okay, so you got to remember the amount made on the sale divided by the amount paid on the sale equals the percent of the profit. And you want to remember made divided by paid is the calculation. So the amount made, what's your profit on the sale? What's your percentage of profit? Well, you got to take what you made on the sale divided by what you paid on the sale. Okay, so I'm going to read this question and you do the quick calculation, see if you can figure it out. Okay, assume a buyer paid $100,000 for a lot and later sold the lot for $150,000. How much profit did the property owner make on the sale? So for this one here, it's calculated. So if the sale price was 150 and the property amount he paid for it was 100, you subtract it, the profit was 50, right? So if you say to figure out what percent he made, you got to take what he made divided by what he paid, right?
That's right.
Okay. So let's say here's an example. A lot was purchased for $75,000. The owner later sold the lot for $93,750. What was the percentage of the profit on the sale? That could be a question like that you see. So you have to determine the amount of profit first, right? You got to know what he made before you can divide it by what he paid, right? So you got to take 93,750 minus 75. He made 18,750. So you take the 18,750 amount made divided by the amount paid, and you get 25%. So he made 25% on that property. Okay. Does that make sense?
It makes total sense.
Okay. Now let's look at a loss. A loss is how much you sell below your cost. So the amount lost on a sale divided by amount cost on the sale equals the percentage lost. So the hint for this one, like the other one was made divided by paid, this one is what you lost divided by cost will give you the percentage. So an investor purchased a lot for $100,000 and had to sell the lot for $80,000, resulting in a $20,000 loss. What was the investor's percentage of loss? $20,000, the amount of the loss, divided by 100,000, the amount of the cost, is 20%. 20% loss, right? Give me 1 second here. Okay, next, we're going to look at a percentage of loss example. So let's say a developer purchased a lot for $125,000 with the hopes of getting the lot rezoned for professional offices. The developer was unsuccessful in getting the lot rezoned and sold the lot based on current zoning for $100,000. What was the percent of loss? So the first thing you have to do is you determine the loss of the sale. 125 minus 100,000 is $25,000 loss. You have to calculate the percentage of loss. You take the loss divided by cost, right? So $25,000 loss divided by 125,000 is 20%, 0.20. You move the decimal, you got 20% loss. Okay. Now let's look at a cost of a lot example. So a lot sold for $35,000, making 25% profit. What was the original cost of the lot? So you have to take the 100% cost, which was, you take the 100% cost plus 25% profit equals $35,000 selling price. That's the formula. So basically, 125% equals $35,000 selling price. So you take $35,000 is what he sold it for, divide it by 1.25. And the original cost of the lot was $28,000. Right? Because if 35,000 was 25% over 100%, it's 1.25. That's how you got that, right? Does that make sense?
Yeah. He basically moved the percentage two spots to the left to
Right.
get it to decimal form so that he can then
Right.
use it. Yeah.
Correct. Right? Because if 35,000 was his cost plus 25% profit, that's that, right?
Yeah.
Okay. So let's look at the preliminary steps to closing a deal. So the first thing that happens when you have a contract, there's earnest money deposited. There's an additional deposit if required in contract. There's a loan application. There's contingencies, inspections, all that stuff, appraisals, loan approval, survey, title insurance, termite inspections, and any other inspections, any repairs that need to be done. Home inspection gets done. The buyer gets insurance put in place. The closing documents are reviewed. There's an inspection walkthrough. The buyer is informed of the amount of the funds needed to close, and there's earnest money, and it's transferred to the closing agent. That's the deposit money goes to the closing agent. There's prorated expenses. Okay. To prorate means to divide various charges and credits between the buyers and the sellers. Contracts should specify a date and time for the prorating items. So if the closing is on October 6th, that's the date and time of the closing, October 6th, 5 p.m., 3 p.m. And then midnight before the day of closing is customary. So there'll be a credit which one party gets reimbursed and a debit where the other party's charged to equal it out. These are like things that are split up on a monthly basis. Okay. So if you're closing on October 6th, like at midnight, October 5th is the date for certain things. And October 6th will be the date of the buyer taking over, right? So the 5th would end for the seller. The 6th would be for the buyer, right? So the items that get prorated, you have property taxes for the current year, rental income, if there's any rental income on the property for the month, interest, if it's an assumed mortgage, if there's an assumed mortgage happening, there's going to be interest that has to be debited and credited. And the prorations are done two different ways. There's a 365-day method and a 360-day method. The question, when you're asked, will determine, it'll tell you, use the 365-day, use the 360-day method. It'll tell you in the question how to calculate it. Okay, so let's look at prorating property taxes. So property taxes are paid in arrears, okay? So for example, you live 2023, in 2024, you pay for 2023. In 2025, you'll pay for 2024. So you live the year first, and at the end of the year, you pay for your taxes, okay? So seller days are used to calculate the proration. That means the seller lived there all year. Now they're closing in October. They got to give the buyer all the taxes from the whole year because the buyer is going to take over now. They'll have to pay from now to the end of the year. But next year, they're going to have to pay all year's taxes. And because the seller lived there all the year, they got to give them money, right? That makes sense?
Yes, it makes sense.
Okay. So the unpaid property taxes are entered onto the closing disclosure as a credit to the buyer and a debit to the seller because the seller is paying it and the buyer is getting it. A credit's when you get it, a debit's when you pay it. Okay.
Would an interesting or good way to remember that would be that someone gets credited and the other one gets debited?
What do you mean?
Like,
Yeah,
like,
one party is always going to get credited and one party
Yeah.
is always going to get debited.
Yeah, it's always going to equal out. Whatever they credit them is what they're going to debit them in this situation. Sometimes it doesn't, but this one, yes. If they're whatever the amount is the same because they're giving them the same amount, right?
yeah.
But credit is happy, debit is bad, right? What do you use your debit card for?
A lot of things.
To pay for things, though, right? You're giving people money.
Yeah.
So you use your debit card to give money, right?
Yep.
Prorations always have the same dollar amount. That's what we were just talking about. If it's $1,300, it's $1,300. It's always the same number. It offsets. Debit, credit has to offset each other. Okay. So the formula for unpaid property taxes. The property taxes for the year divided by 365 days gives you a daily tax rate. The daily tax rate times the number of days the seller owns the property in the year is the proration amount. It gets credited to the buyer, debited to the seller. Right? So if it's X amount of dollars, you divide it by 365, it gives you how much per day. How many days did the owner sell? So October 6th, you got to figure January 30, February 28, March 31, April 30. You got to write down and add them up. And you got to get the days to the day. And then the date of the selling, it says here, the seller days. So the date before will be the day of the amount. Now watch. Let's use this calculation. The annual property taxes are $38.40. The day of the closing is June 15th and is charged to the buyer. That means the buyer owns the 15th. So the seller only has to June 14th, right? Because if the buyer owns the 15th, the seller owes the taxes to the 14th. So calculate the prorations using the 365-day method. Who will receive a credit and who will receive a debit? You take a minute and figure that out. You want to try to work on that?
Yes, I got it.
Okay, go ahead. Okay, so what do you got?
So in this case, in a normal year, there's 120 days from January the 1st to June the 14th. And then the amount,
How many days you have?
120.
Okay, so go ahead.
120 days, right? And then I got the 120 right there, and then the amount that they actually end up paying, that the seller is going to be debit, is going to be $1,262
Yeah,
with
let's look at
46 cents.
off a little bit.
Hmm.
So the first thing you do, you have the property taxes. Okay. It's 38.40 divided by 365. That's the first thing you have to find out.
Yeah.
So it's $10.52, 10.5205. Did you get that number?
Yes, I
Okay.
got that number. The
Okay.
issue was with the
So
days.
that was there. Okay, so now let's look at the days. January is 31, February is 28, March is 31, April's 30, May is 31, and 14 days of June.
That's what it was.
So we have to add the 165. Now you take the 10.5205 by 165. So you missed what? 45 days? What'd you miss?
31 actually. I missed January's.
January. Okay, that's okay.
Yeah, that's what it was.
When you do it, just be careful.
Yeah.
You got the math right. You just got the wrong days.
Yeah, that's what it was.
And you got to memorize the days. Are you know all the days of the month, like each one? You have it memorized?
Yeah, somehow. Yeah. What?
Okay.
So when they tell you the 365 day, that's the actual days in each month. When they
Mhm.
tell you by 30 days, they'll tell you, go back one slide, Deb. See how it says use the proration using the 365-day method?
Yeah.
If they want you to just use 30 days a month, it'll say the 30-day method.
Okay.
Yeah, then
There's
it would just be 30 by, whatever, and you would just calculate. It's easier. But they're in this kind of problem, they're going to do 365.
Gotcha.
But the difference there is the number. It's just the number you had. Right? So you're going to see one like that for sure.
They ever tell you the knuckle method to remember the days of the month?
I will look into it. I didn't quite raised. I was not raised here, so that's not a thing that is taught in my country. But I will definitely be.
Yeah, it's
Looking
just
into that.
like your hands like this, and it's based off your knuckles. So everywhere there's a
Mhm.
knuckle, it's 31 days. So January
Okay, so
31.
you put your hands out like
All
this.
right, you want to tell?
You start at the knuckle on the side. So knuckle is January. In between is 28. The next knuckle is March. The knuckle is always 31.
Okay.
January is 31. You go into then there's a knuckle that's 28. February 28. March is 31. April's 30 is in the knuckle, right? Is in the gap, right? May is 31. June is 30 in the gap. July is 31. And then when you put your hand together, there's another knuckle. August is 31. September is 30, right? You see how I'm doing it? So 31, 28, 31, 30, 31, 30, 31. You put it here, 31, 30, right? So
Yeah.
August 31, September 30, October 31, November 30, December 31. So you just go by the knuckles. And that way you can do it. Does that make sense? I learned that in
Yeah, it
elementary
makes a
school.
lot of sense. I appreciate it.
So, yep.
Appreciate it.
All right. So there you go with that. Now, Let's look at prorating items that were paid in advance. Okay, items paid in advance, such as rent, uses the buyer's day to calculate the proration. So calculations will assume rent is paid on a monthly basis and on the first of the month. The buyer's days are used to determine how much of the tenant's monthly payment belongs to the new owner, the buyer, as of the date of closing. So prepaid rent is entered as a credit to the buyer because the buyer is getting it, and a debit to the seller. Because if you're closing on the 15th of the month and the tenant paid the landlord on the first for the whole month, the seller gets it for the first 15 days, and then the buyer gets it he gets it for 14 days. And then the buyer gets it for the day he buys it going forward, right? So same thing. You got to calculate it because it's going to go from the seller to the buyer. So a rental property will close on June 15th, and the closing day belongs to the buyer. The seller has collected $1,000 rent at the beginning of the month. Calculate the proration, and how will the proration be entered on the closing disclosure? So you have to figure out how much the rent is per day, right?
Yep.
Okay,
Yeah,
so we'll go through. I'll go through it. Don't worry about calculating. We'll go through it. So let's look at it. Okay, so you calculate the buyer's day using the closing day through the last day of the month, June 15th to June 30th. Okay, so you know there's 30 days. So the 15th is the buyer's day. So that's 16 days. Because if the buyer owns the 15th plus 16 all the way to 30, that's 16 days. Now you have to understand that, because if you put 15 days, that answer will be on the test too. They try to trick you. So you have to understand, if it's closing on the 15th, the buyer owns that day. So the 15th and then the 16th all the way to the 30th, the buyer owns. So it's 16 days, not 15. Okay.
Gotcha.
And if you take the monthly rent and divide it by the daily rate, so it's $1,000 by 30 days, which is 33.33333. And then you multiply that by 16 days. So the seller is going to have to credit the buyer $533.33, which is the remainder of the month from the 15th on, right? So you debit the seller $533.33. The seller owes the buyer the day of the closing, rent, and remainder of the month. The credit to the buyer is $533.33, day of the closing and the remainder of the month. So it offsets each other, right? It goes from him to him, or her to her, or whatever, right? That's another problem you'll see, something like that. Does that make sense? Clear?
Yep, makes total sense.
Now let's talk about mortgage interest on an assumed mortgage. Only on an assumed mortgage, okay? Not on a new mortgage, an assumed mortgage. Interest on a mortgage loans are paid in arrears. Again, when you pay October's mortgage, you're paying for September. It's September's payment and September's interest. When you pay November, it's for October. You're always paying a month. You live, then you pay. You live, then you pay, right? So it's always in arrears, just like taxes. When prorating an item paid in arrears, you use seller days. So that means the day of closing belongs to the seller when it's in arrears, okay? And you always debit the seller and credit the buyer, okay? So formula, interest on an assumed mortgage. You got to take the loan balance, multiply it by the interest rate, and that'll give you the annual interest rate. You take the annual interest rate, you divide it by 365 days to get the daily interest rate. Then you take that daily interest rate and multiply it by the days the seller owns in the closing month. And the proration amount will be a credit to the buyer and a debit to the seller, because you're assuming the mortgage is not being paid off. So the seller lived there for part of the month. They have to give you the interest, because when you make the next mortgage payment, you would be paying the interest for when they lived there if they didn't give it to you. Does that make sense? Good. You got that or no?
Yep, makes total.
Okay.
Yes.
Okay. So they have to give you the interest, just like they have to give you the rent, right? So let's look at this. A buyer is purchasing a property by assuming an existing loan with a balance of $110,350. The closing is scheduled for April 10th, with the next mortgage payment due May 1st. The interest rate is 4%. Okay. So the first thing you have to do is you have to find out what the interest is, right? So you take 110,000. I'll go to the next page. Calculate the proration amount and indicate which party will be charged a debit and which will receive a credit, right? So we already know the debit's the seller, credit's the buyer. We know that. So what you have to do is you got to calculate the daily interest rate. 110,350 times 4% is $4,414 in interest per year. Divided by 365 days, it's 12,000, and you got to have all the numbers. You don't round it. Whatever the numbers are in the calculator, use it. Okay. 12.09315 per day. So you take the calculation, you calculate, then you know that. So the interest is 12.09315. Now you have to calculate the number of days the seller owns the property in the month. Okay, so April 1st to April 10th is 9 days. Okay. So you take the daily interest rate and the seller's days, and the proration amount equals a proration amount. So 12.09315 times 9 days is $108.84. And that's a credit to the buyer and a debit to the seller. Again, like on a test, they'll show you 10 days too. Because if you get the days mixed up and not realizing that it's the seller's days, that answer will be there too. So you got to make sure you know it's seller days, right? Good.
Yeah, the only part that I'm kind of I haven't quite not necessarily understood, but like kind of it has inside of my mind properly is the whole day situation.
Right. So here it is. I'll make it easy for you.
Go ahead.
The seller's living there. Okay. They're living there to the day of closing. So the 10th is the closing. The seller still lives there that day. So they got to pay the interest for that day on this. When a buyer's buying it, they're buying it that day. That money's going to belong to them. On an assumed mortgage, it's 9 days. So you have the first, the second, the third, the fourth, the fifth, the sixth, the seventh, the eighth, the ninth, the 10th. See, the 10th would have been 10 days. But because it's an assumed mortgage, it's seller days. You just got to memorize that. There's no way to know that. If it's an assumed mortgage, it's seller days. If it's rent, it's a buyer's day, right? You just got to know the buyer's taking it that day. It's his money. Okay. You just got to memorize it. There's not a way to like relate that to something.
All right.
Now we're going to talk about state transfer taxes. Okay. There's state documentary stamps on tax deeds. Okay. It's 70 cents per $100 of full purchase price. And for some reason, only in Miami-Dade County, it's 60 cents. You got to remember that in case it says it's Miami-Dade. If it's anywhere else, it's 70. If it's Miami-Dade, it's 60. Okay. That's your state doc stamps. Your state documentary stamps tax on a promissory note is 35 cents per 100 on a note amount for all new and assumed mortgages. Okay. And then you have a state intangible tax on mortgages. It's 0.002 per dollar on the amount of a new mortgage loan. On a new mortgage loan. Okay. So you have your state doc stamps on tax deeds, 70 cents per $100 of the full purchase price, 60 cents in Miami-Dade. State doc stamps on promissory notes. Okay. 35 cents per 100 on the note amount for all new and assumed mortgage notes. And state intangible tax on mortgages, 0.002 per $1 of the new mortgage loan, not assumed, new. Okay, so let's look at this. Doc stamps on tax deeds. Okay, this is a tax paid on deeds and other conveyances. It's assessed on the full purchase price. It's assessed at the rate of 70 cents per $100 of the full purchase price, 60 cents per 100 in Miami-Dade. It makes no difference whether the purchase is cash, financed, or mixed. Makes no difference. This tax is a debit to the seller only. Only the seller pays the tax stamps. This has nothing to do with the buyer. So remember, the other ones were debit, credit. Tax stamps are only a debit to the seller. They're sad. They got to pay their taxes to the government on the sale. That's what this is. It's a one-time tax paid at closing, not annually. They sell the house. They got to pay their taxes on the sale of the house. Okay? So let's look at this. What's the formula? You take the purchase price, you divide it by 100, and that equals a taxable unit. When you get a taxable unit, you round it up to the next whole number. There's no partial. So if it's 17.1, it's 18. If it's 17.9, it's 18. If it's whatever, if it's point anything, it goes up. The number of taxable units times 70 cents is the cost of the doc stamps on the deeds. 60 cents in Miami-Dade. So let's look at this. A home sells for $150,000 and $150,025 in Duval County. Calculate the doc stamp on the deed. Remember, there's no partial stamps. Round taxable units up to the next whole number. Okay, so let's look at the solution. You take 150,025 divided by 100. It gives you 1,500.25. You got to round it up, right? So it's 1,501. 1,501 times 70 cents. The tax stamps are 1,050, 70 cents. If it was Miami-Dade, it'd be 60 cents here, right? That's how you find out what your tax stamps are.
Interesting. Interesting that he rounded it up to the next to the next one, as opposed to.
If it's a penny over, it goes up. You know why?
Why?
It's the government.
Sounds great.
You don't round down ever. They take it all.
I love it.
That's how you can remember that. But if the government owed me, it would be down, right? It would round down.
Definitely.
That's how you can remember that. So let's look at the doc stamps on promissory notes, right? So now, doc stamps on the sale price is the seller's problem, right? Because he's making the money. Doc stamps on a promissory note. Well, who's getting a promissory note?
Who's getting it?
Yeah, who's taking a promissory note?
The buyer, I think.
Right. The buyer is getting a note and a mortgage, right?
Yeah,
So who do you think pays the tax on a promissory note?
the buyer.
Right, not the seller, right? Buyer only.
Yeah.
Okay, so this is paid on all new and assumed promissory notes. Okay, so if he's buying a house for 200,000 and he's only borrowing 150, this would be based off the loan amount, not the sale price, right? It's the promissory note. Okay,
Right.
so this does not apply to cash purchases. If you buy a house cash, there's no promissory note, right? The tax rate is 35 cents per $100 on the face value of the promissory note. If it is an expense usually charged to the buyer. Okay, now, they say usually, because in the contract, you can negotiate. You can say the seller is going to pay all the buyer's closing costs. And in that case, the seller would pay this. But usually on 99% of the transactions, the buyer pays it. Okay? Unless you negotiate it, the buyer's paying it. Okay?
Got it.
The tax is entered as a debit to the buyer only on the closing disclosure. Right? Because the buyer is the only one paying it. So the formula, promissory note, the amount of it, not the sale price, the promissory note, divided by $100 is the taxable units. There's no partial stamps. You round up to the next number. Taxable unit is 35 cents. The taxable units times 35 cents is the cost of the doc stamp tax on the promissory notes. So let's say a buyer purchases a property by assuming an existing loan for $62,350 and securing a new loan for $110,000. Remember, doc stamps are paid on the new and assumed promissory notes, not cash. Okay, so let's look at the formula. Doc stamps are paid on new and assumed notes. So you can't add them together. You got to do them separately because it won't add up right. You got to calculate separately. So you got to take 62,350 divided by 100 because that's the assumed loan, right? So 62,3.5, you round it up, so 624 times 35 cents is $218.40. Then you got to take the 110,000 divided by 100 is 1,100 units. There's no rounding on that one. It's by 35 cents. It is $385 doc stamp tax on a new note. The total doc tax stamps on the note is $218.40 plus $385 is $603.40. This will be your total doc stamp on the promissory note for the buyer. $603.40. Does that make sense?
It does. I will have to, read it afterwards.
We'll calculate. Yeah, you work on them, and we're going to do some review as well. But you got to remember, always round up and do them separately if it's like this. Because if you add them together, it's not going to add up to the right numbers because of the rounding. Okay.
Got it.
Now let's talk about the intangible tax. Intangible tax.
And we'll come back on this part.
All right, yeah, we could do that. We could do that. You want to take a 10-minute or you want to finish it up first?
Well, we should have taken the 10 minutes ago.
Yeah, that's fine. All right, so let's do that. Let's take a 10-minute. We'll take a 10-minute break. Come back at 1:12, and we'll continue up on this.
All right, be back.
We're gonna pop back on here a couple more minutes.
No worries.
All right, you guys ready? Okay, so let's talk about the intangible tax on new mortgages. Okay, who do you think pays this? Who's getting a mortgage?
The person getting the mortgage is the buyer.
Right. Right. So these are paid on new mortgages only, not assumed, not on cash, right?
Yep.
Okay. All right. So the tax rate is 0.002 per dollar of debt. Usually shows as debit to the buyer on the closing disclosure. Nothing shows on the seller side. It says usually because you can negotiate that the seller pays for it, but usually it's 0.002 per dollar, and that's the cost of it on the buyer side only. Okay. So a buyer purchases a property by assuming an existing loan for $62,350 and signing a new mortgage and note for $110. Intangible taxes are charged on new mortgage loans only. Okay. So the solution here is $110,000 times 0.002, and that's $220 intangible tax. Nothing on the assumed, right?
Yep.
So let's look at the rules of thumb. The purchase price is entered as a credit to the seller because they're getting the money, and a debit to the buyer because they're paying the money. New purchase money mortgage is a credit to the buyer towards the purchase price and a debit to the seller because it receives their money at close, reduces their money. Purchase money is when they're given the loan, right? So that's why it's on both sides. Mortgage is assumed by the buyer. It's a credit towards the buyer's purchase price. And that's also a debit to the seller because it reduces their money being received. So if there's an assumed mortgage or a purchase money mortgage, it's a debit and a credit, right? Debit seller, credit buyer. If it's a purchase, it's a credit seller, debit buyer. If it's cash or a mortgage, that's not purchase money or assumed. Clear?
Could you explain that again, please?
Right. If somebody's buying a house and they're getting a mortgage from a bank or paying cash, on the disclosure, it's credit to the seller, debit to the buyer for the price. If it's a new purchase money mortgage, if the seller is holding the mortgage, it's a debit to the seller, credit to the buyer because the seller is giving them the money. Right?
Yes.
If it's a mortgage assumed by the buyer, it's a credit to the buyer because they're getting the mortgage, but it's a debit to the seller because they're assuming the seller's mortgage. It's going to them. Okay.
All right.
Good.
Yep.
Items credited to the seller. Only time the seller gets money is a total purchase price and a prepaid items. That's it. That's when the seller gets credited. Items debited to the seller. Okay. Mortgages paid off. Prorated property taxes. Mortgage loan interest and assumed mortgage payment, assumed mortgage interest, prepaid rents, tenant security deposits, state doc stamps, right? They got to pay their taxes, brokers' commissions. If there's brokers involved, the seller is usually paying those. Title insurance for the owner's policy, preparation of the deed, and any attorney's fees they have. That's all costs to the seller. So these are credits to the seller. These are all costs to the seller. Okay. Debit means they're paying. Let's look at the buyer side. Items credited to the buyer. Any deposit, any earnest money deposit they put down on the house. Okay. A new mortgage. If they're getting a new mortgage, is a credit to them. Prorated property taxes, right? Any taxes coming from the seller, they're going to be credited to the buyer. Any prorated mortgage interest, right? Any prorated advance rent coming from the seller, right? Anything that would be going to them. Any security deposits, like say it was a rental and they had security deposits on hold, they would come over to the buyer, right? Everything would come to the buyer. Let's see what's debited to the buyer. The purchase price, the title insurance for the mortgage policy, and the buyer side. State intangible tax on new mortgages, state doc stamps on new and assumed mortgages. That's the 35 cents, right? Per thousand, 2.002 per dollar. Recording of the deed, they got to pay for that. Recording of the mortgage, any attorney's fees that they had, and any preparation of mortgage and note, any lender fees, things like that. Okay. So the key concepts regarding closing disclosure. What goes where? Who's debited and credited? These are key concepts. The total purchase price. Always remember, credit to the seller, debit to the buyer. Only entries in credit column on the seller side. So on the seller side, the only entries that will be credited on their side only and is purchase price and any item seller prepaid. And then the new purchase money mortgage and assumed mortgage loans are a credit to the buyer and a debit to the seller. Right? Because that's when the seller's money is involved in the financing. New lender financing, not seller financing, and earnest money deposits. Okay. This is where it's a credit to the buyer and no entry on the seller side. Okay. Only the credit to the buyer. Unpaid property taxes are a credit to the buyer and a debit to the seller. Okay.